Folks, you are not going to believe what the volatility index did this week. She sat there at 17.2, practically daring the entire world to try and scare her. Headlines screamed about fresh sanctions, fresh naval posturing in the Strait of Hormuz, and even whispers of unjammable drones moving toward Iran. Markets should have buckled. Instead, the S&P 500 pinned itself like a butterfly on a board, never moving more than a handful of points day after day. And through it all, that volatility index refused to flinch. She held her ground in the high teens, as if she had seen this movie before and already knew how it ended. This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. Now listen, if you remember nothing else from this week, remember this. The market walked into a geopolitical firestorm and decided the fire was already priced in. That is the story I'm going to unpack for you today. Not with dry numbers, not with charts you have seen 1,000 times, but with the real narrative the tape was whispering while the pundits were shouting. Because you and I both know what really happened here. The headlines sold panic. The tape sold patience. And in that gap between the two sits an opportunity that disciplined traders turned into steady premium collection. Let us go all the way back to the beginning of the week. Monday morning, the world woke up to fresh United States sanctions targeting Iranian military procurement networks. The Strait of Hormuz suddenly felt smaller. Naval vessels were posturing. Oil traders started twitching. You would have expected the S&P 500 to open with a gap lower and the volatility index to jump at least a couple of points. Instead, what happened? The S&P 500 opened right where it had closed the previous week. It just sat there, almost defiant. The volatility index, that character we have come to know so well, refused to take the bait. She opened the week at 17.4 and basically yawned. She has moods, you know. Sometimes she whispers when everyone else is screaming. This was one of those times. She looked at the sanctions, at the drone intelligence reports coming out of Russia and Iran, and she simply refused to get excited. Now ask yourself, when was the last time you saw a setup this clean? Geopolitical tension that should have lit a fire under volatility, and yet she stayed right there in that calm 17 to 18 range that we have come to associate with disciplined conservative positioning. Here is the thing. While all of this was unfolding in the Middle East, something else was happening in Asia. China posted stronger than expected export numbers, a solid beat that suggested their economy was showing resilience, even with tariffs hanging over everything. That data hit the wires, and suddenly Bitcoin, which had been hovering just below $80,000, decided to push higher. It climbed above 80,000 in weekend trading and kept that tone into Monday. Now that is the first unexpected connection I want you to chew on. While the Middle East looked like it was headed for trouble, crypto was quietly telling a different story. It was saying that selective risk appetite was still alive. Institutional money was not running for the hills. It was rotating. It was waiting. And that patience showed up in the S&P 500, which refused to give back any ground. Tuesday followed the same script, but with a new wrinkle. Diplomatic momentum started to build. Word came that United States-Iran talks might resume in Islamabad the following week. J.D. Vance held a closed-door meeting with the Prime Minister of Qatar. Suddenly the tone shifted from confrontation to negotiation. You and I know what that usually does. It should have crushed volatility even further. But the volatility index did not drop sharply. She held steady at 17.4 again. She was listening, but she was not convinced. That is her personality. She does not trust easy headlines. She waits for the tape to confirm. Meanwhile, the dollar, which had started the week strong, began to show the first signs of softening. It traded right around 98.5 before easing just a touch. That move was important because when the dollar takes a breather, safe haven assets tend to breathe easier too. And that brings us to gold. Gold started the week at $4,519.50, and it did not waste any time. It climbed steadily, deliberately. By Tuesday, it had pushed to 4,555. That move was not loud. It was not accompanied by screaming headlines, but it was speaking volumes. Gold was saying that even with diplomatic talks on the horizon, the underlying risks had not disappeared. It was positioning for the possibility that those talks could drag on or break down entirely. Now here is where it gets interesting. The S&P 500 on Tuesday settled at 7,259. It had not moved much from the open of the week, but that quiet stability was deceptive because underneath the surface, the cross currents were swirling. Oil, which opened the week at $106.42, started to give back ground. It fell to $102.27. That drop might have surprised some people. After all, with all the talk of the Strait of Hormuz, you would expect crude to spike. Instead, it eased, and that told us something important. The market was pricing in the idea that any disruption would be temporary, that diplomacy, even fragile diplomacy, was winning the narrative for now. The volatility index kept her composure through all of it. She closed Tuesday still at 17.4. She was not buying the fear. She was not selling the relief. She was simply observing. And that observation mattered for every trader sitting at their desk, wondering whether to place an iron condor or step aside. Because when she stays in that 17 to 20 zone, the conservative tier becomes the only logical place to operate. The aggressive strikes get blocked by the risk scaling rules. The engine stays disciplined. No temporal theta martingale gets triggered because the expected daily range never breached the gate. That is how we protect capital in times like these. We let the volatility index tell us what she is willing to tolerate. And this week she was tolerating quite a bit of headline noise without raising her voice. By the end of Tuesday, the stage was set. We had sanctions and naval posturing colliding with diplomatic overtures. We had China showing strength in exports ahead of a Trump-Xi summit. We had Bitcoin holding firm above 80,000. We had gold climbing quietly. We had oil easing back. And through it all, the S&P 500 refused to break out or break down. It was pinned, perfectly pinned. That pin is what made the week so fascinating, because a pinned market in the face of geopolitical tension is not normal. It is a signal that big money had already positioned for this exact scenario months ago. They had bought the rumor. They were now waiting for the news to catch up. And that is exactly what smart money does. It anticipates. It does not react. I have to tell you honestly, this was one of those weeks where the mainstream financial media got it mostly wrong. They focused on the sanctions. They focused on the potential for oil supply shocks. They focused on the drama. But what they missed was the tape. The tape was saying that volatility had already priced the worst case. The tape was saying that the Powell to Warsh transition at the Federal Reserve was being watched closely, but not feared. A tighter, more data-dependent chair might actually support the dollar and keep volatility contained. That is what the bond market was whispering. That is what gold was confirming with its steady climb. And that is what the volatility index was endorsing by refusing to spike. So by Tuesday night, the central tension of the week was clear. Would the geopolitical noise finally break the pin? Or would the market continue to treat these headlines as noise rather than signal? The volatility index was betting on noise. She stayed calm. She stayed in contango. She kept that spread between the short-term and longer-term measures healthy. That strong contango, by the way, is the normal state of markets. It is when longer-dated volatility is priced higher than near-term volatility. It is the setup that lets theta collectors like us do what we do best: collect premium on the expectation that the market will stay within a defined range. And this week, that expectation looked rock solid. But of course, the week was only just beginning, because what happened next on Wednesday and Thursday would test whether that calm was justified or whether the volatility index had been lulling us into a false sense of security. And that, my friends, is where the story takes its first real turn. Wednesday changed everything, not because the market finally broke, but because it did not. The S&P 500, which had been hovering around 7,259, suddenly found its footing and pushed higher to 7,365. It was not a violent move. It was a deliberate one, and the volatility index responded in typical fashion. She eased just a bit to 17.4, but she did not collapse. She stayed right there in that high teens range, as if to say, I told you so. This is where the second unexpected connection revealed itself. While equities were finding strength, gold accelerated its climb. It moved from 4,555 to 4,681. That is not a small move. That is a statement. Gold was not just reacting to dollar weakness. Although the dollar did soften to 98.02, gold was also reacting to the persistent underlying risks in the Middle East. Even as talks were scheduled for Islamabad, the naval posturing continued. UK carriers were absorbing massive fuel costs from the ongoing conflict. British Airways alone facing an extra 1.7 billion in fuel surcharges. That is the kind of real economic impact that does not show up in the headlines, but shows up in commodity prices. And here is what the mainstream missed. The bond market started to price in a different Federal Reserve path. The 10-year yield, which had opened the week at 4.45%, eased to 4.36%. That drop was meaningful. It suggested that even with talk of a Powell to Warsh transition, the market was not expecting aggressive tightening. It was expecting data dependence. And that expectation kept volatility from exploding. The volatility index looked at all of this, and she smiled. She refused to break above 18. She stayed in that disciplined zone that allowed conservative iron condors to breathe. Now listen, this is where it gets really interesting. Bitcoin, which had pushed above 80,000 on Monday, continued to show resilience. It climbed to 81,428 by Wednesday. That move happened while Indian equities were taking a hit from the risk-off flows tied to the Iran sanctions. India saw a sharp sell-off earlier in the week, but its long-term growth narrative, particularly in defense infrastructure and energy, stayed intact. Strong financial earnings from names like PTC India underscored that resilience. So while one emerging market was feeling pain, another was showing structural strength. And crypto was sitting in the middle of it all, acting as a barometer of institutional risk appetite. That is not a connection you hear on CNBC, but it is the connection that mattered this week. Thursday brought the twist inside the twist. The S&P 500 pushed even higher to 7,398. It pinned itself right at that level. The volatility index dropped to 17.1. She was practically laughing at the headlines now, because by Thursday, the diplomatic signals were getting louder. Talks in Islamabad looked more likely. Qatar was mediating. Secretary Rubio was pressing Europe for concrete action, but the tone had shifted from escalation to negotiation. And yet oil continued to fall. It dropped all the way to $94.81. That was the third unexpected connection. Oil was decoupling from the geopolitical narrative. It was telling us that supply risks were being overstated, that OPEC or other producers could step in, that the market had already hedged the tail risk. Gold, however, kept climbing. It hit 4,699 on Thursday. That steady ascent throughout the week was the quiet hero of this story. While the S&P 500 pinned and the volatility index calmed, gold was doing what gold does best. It was protecting against the unknown. It was responding to the dollar, which had weakened further to 98.25. It was responding to the real interest rate environment where yields were easing. And it was responding to the persistent uncertainty around any potential breakdown in those Islamabad talks. The volatility index by this point had become almost smug. She had watched the entire week unfold. Sanctions, naval clashes in the Gulf, fresh threats to resume certain projects, diplomatic maneuvering, China export strength, Indian earnings resilience, and through it all, she refused to break out of that 15 to 20 regime. That is the regime where our risk scaling rules keep us in the conservative iron condor only. No aggressive strikes, no oversizing, just clean defined risk setups placed between 3:05 and 3:14 Central Standard Time each day. Each trade independent, each trade expiring the next market day. No carryover, no rolling. Just binary outcomes. Full credit if it expires worthless. Defined loss if a leg is breached. And that brings us to how VixShield navigated this environment. The RSI signal was clear. 4 place days and 1 hold day. Conservative tier only. The expected daily range never got high enough to trigger any martingale or layered adjustments. The adaptive layered VIX hedge stayed in the background, ready, but not needed. That is the beauty of the system. It does not force action. It waits for the volatility index to give the signal. And this week she gave the signal to stay disciplined, to collect theta in a contango environment, to trust the pin. I have to admit, this was one of those weeks that reminds me why we built this the way we did. Because when the headlines scream and the volatility index whispers, it is easy to get sucked into the drama. But the real tape, was showing something different. It was showing a market that had already digested the geopolitical risks, a market that was focusing on selective strength in artificial intelligence names that drove the Nasdaq and the S&P to record territory despite the Middle East noise. A market that was watching the Powell to Warsh transition, not with fear, but with analytical detachment. Because a tighter, more rules-based Fed might actually be bullish for the dollar over time. And that dollar strength would eventually weigh on gold, but not before gold had its say. The twist of the week was not a violent move in any direction. The twist was the absence of violence. The twist was the pin. The twist was the volatility index refusing to play the role the pundits had written for her. She stayed calm. She stayed contained. And that calm allowed patient traders to do what they do best. Harvest premium inside defined risk structures that do not care about the headlines, only about the math. But of course, every story needs a resolution, and Friday delivered one that tied all these threads together in a way that only the tape can do. Friday was the payoff. The S&P 500 closed the week right, where it had pinned itself at 7,398.93. Not a single point of movement from Thursday. That kind of precision does not happen by accident. That is big money defending a level. That is the market saying we have found equilibrium. The volatility index closed at 17.2. She had drifted slightly higher from Thursday, but she was still comfortably within the regime that favors conservative positioning. She had done her job. She had kept fear contained even as the week threw every kind of geopolitical headline at her. Now here is what I find fascinating. As the week resolved, gold continued its climb all the way to $4,720.40. That 4.67% move on the week was not noise. That was a deliberate repositioning into safe haven assets, even as equities pinned at all-time highs. That divergence is exactly what we watch for, because when gold climbs, while the S&P 500 stays flat, it is telling us that the risk premium has not gone away. It has simply moved to a different part of the portfolio. Smart money was hedging. Smart money was protecting. And that protection showed up in the precious metals complex. The dollar finished the week at 97.84. It had given back ground steadily after starting strong. That weakening supported the gold move. It also supported emerging market currencies that had been under pressure from the Iran-related risk off flows earlier in the week. India, which had seen a sharp sell-off midweek, found some stability by Friday as its long-term structural story in defense, energy, and infrastructure reasserted itself. That is another thread that tied the week together. Geopolitical tension in one region, creating temporary pressure in another, but not derailing the underlying growth narrative. Crude oil settled at $95.42. It had fallen sharply from its Monday open, but it stabilized into the close. That stabilization suggested that the market had found a new equilibrium on supply concerns. The Strait of Hormuz risks had not disappeared, but they had been priced. OPEC was watching. Alternative supplies were being considered, and the price action reflected that reality rather than the headlines. Bitcoin closed the week at $80,187. It had swung throughout the 5 days, but it held above 80,000 for most of the period. That resilience in crypto, while equities pinned and volatility stayed calm, was the final confirmation that risk appetite had not been destroyed. It had been tested. It had been selective, but it had endured. Ethereum finished at $2,307, showing a bit more weakness, but still participating in the overall risk on tone. The 10-year yield closed at 4.36%. That easing from the Monday open supported the narrative that the Federal Reserve transition was being viewed through a pragmatic lens. Warsh as chair might mean a more data-dependent dot plot. It might mean slightly tighter policy over time, but it did not mean chaos. The bond market believed that. The volatility index believed that. And the equity market expressed its belief by refusing to break. Now let us talk about how VixShield performed inside this environment, because this is where the rubber meets the road for every listener who has capital at risk. We placed 4 trades this week. 3 of them expired worthless for full credit. 1 hit the short put for a defined loss. That is the binary nature of these 0 DTE and 1 DTE iron condors. No rolling, no adjustments. Enter collect credit, wait for expiration. Each day a clean slate. Monday's trade expires Tuesday. Tuesday's trade expires Wednesday. No carryover. That discipline is what protects us in weeks like this. The conservative tier was the only tier active. The VIX risk scaling rules blocked anything more aggressive because we stayed firmly inside that 15 to 20 regime. The expected daily range stayed below the 0.94% gate, so no temporal theta martingale was triggered. The adaptive layered VIX hedge remained on standby, ready for any breach above 20 or any expansion in expected daily range, but not needed this week. That is exactly how the system is designed. It does not chase. It does not force. It waits for confirmation from the volatility index herself. And she gave us confirmation every single day. She held in that high teens range. She kept the term structure in strong contango, with the spread between the VIX and the VXV sitting at 3.31 points. That contango is what allows theta to work in our favor. Longer dated volatility priced higher than near term. The market expecting calm to continue. And that expectation was validated by the pin at 7,398. I want you to feel what this meant for your own positioning. If you were sitting at your desk on any of those placement days between 3:05 and 3:14 Central, you felt the calm. You collected that modified credit somewhere around $1.25 on the conservative strikes. You went about your day knowing that the outcome would be binary. Either the market stayed inside the wings and you kept the full credit, or it breached and you took the defined loss. No emotion, no hope, just math. That is the power of these structures. They turn geopolitical chaos into a defined risk equation. The week gave us 3 placement days and 1 hold day. That pattern reveals something important. The volatility index was not offering high conviction setups every single day. She was selective. She was patient. And that patience protected us from overtrading. In a world where the headlines were screaming escalation, the system screamed discipline. That is the lesson of this week. Strict adherence to the VIX risk scaling and the expected daily range gates protects theta collection while preventing oversizing. The layers remain ready. The adaptive hedge remains ready. But readiness is not the same as action. Action must be earned. And on Friday, as the S&P 500 settled at that pinned level and the volatility index closed at 17.2, we could look back at the week and say the conservative positioning worked. It did not capture every point of upside. It was never designed to. What it did was protect capital and generate steady income in an environment that looked far more dangerous than it actually was. That is the entire point of what we do. We are not here to predict the next headline. We are here to position in a way that survives whatever headline comes. The resolution of this week was not dramatic. It was quiet. It was a market that had already done its homework. It had priced the sanctions. It had priced the diplomatic efforts. It had priced the Fed transition. And it had decided that none of those things were worth breaking the pin. That kind of resolution is exactly what disciplined traders live for, because it validates the process. It validates the patience. It validates the refusal to chase. But the story does not end with Friday's close, because when you pull back and look at all the cross-asset signals, all the invisible threads that connected gold and oil and crypto and the dollar this week, a much bigger picture emerges. And that is what I want to explore with you next. Let us pull back now, way back, because this week was never really about one index or one volatility reading. This week was about capital flows responding to a world that is simultaneously tense and stable. And the assets told that story better than any pundit could. Gold climbed steadily from $4,519.50 on Monday all the way to $4,720.40 by Friday. That is a significant move in any week, but in a week where the S&P 500 pinned at record levels, it becomes even more telling. Gold was not rising because equities were falling. Equities were not falling. Gold was rising because the underlying uncertainties had not been resolved. The Iran sanctions, the possibility that those Islamabad talks could fail, the persistent naval presence in the Gulf, all of that created a bid for safe haven assets, even as artificial intelligence strength drove equity multiples higher. That divergence between gold and equities is one of the most important invisible threads of the week. Mainstream financial media told you the market was risk on. Gold told you that smart money was hedging its risk on bet. That is not a contradiction. That is sophisticated portfolio construction. That is exactly what we try to emulate with our defined risk structures. We participate in the calm, but we prepare for the storm. The dollar index tells the other side of that story. It started the week at 98.47 and finished at 97.84. That weakening supported the gold rally. It also eased pressure on emerging markets that had felt the heat from the Iran-related risk-off flows. India, for example, saw outflows and a sell-off midweek. but its structural resilience in key sectors helped it stabilize. The dollar's move was also connected to the bond market, where the 10-year yield eased from 4.45% to 4.36%. Lower yields, weaker dollar, stronger gold. That triangle has been reliable for decades. This week it was working perfectly. Now here is the third unexpected connection that almost nobody is talking about. Bitcoin held above $80,000 for most of the week, even as oil fell sharply, and even as diplomatic headlines swung back and forth. Crypto was acting as a leading indicator of selective risk appetite. While traditional safe havens like gold were bid, institutional money was still willing to allocate to digital assets. That tells us something profound about the current cycle. We are not in a classic risk-off environment. We are in a selective risk environment where artificial intelligence, strength, geopolitics, and monetary policy are all being weighed simultaneously. Oil's collapse from $106.42 to $95.42 was the counterpoint to everything. It decoupled from the geopolitical narrative. It suggested that the market believed any disruption in the Strait of Hormuz would be short-lived. It suggested that alternative supplies and demand destruction fears were dominating. And that move in oil fed directly into lower inflation expectations, which fed directly into lower yields, which fed directly into a weaker dollar, which fed directly into higher gold. See how it all connects. This is not random. This is capital flowing where policy and geopolitics direct it. The euro-dollar pair climbed from 1.169 to 1.179. That move mirrored the dollar weakness and supported the idea that global capital was rotating away from the United States somewhat, even as United States equities pinned at highs. That rotation is subtle but important. It tells us that the rest of the world is not collapsing. It is adjusting, and in that adjustment, volatility remains contained. The volatility index herself was the conductor of this entire orchestra. She refused to get loud. She refused to spike. She stayed in that 17 range like a seasoned trader who has seen every version of this movie. She watched the Powell to Warsh speculation. She watched the BRICS cohesion get tested by the Middle East fault lines. She watched China deliver export strength ahead of the Trump-Xi summit, and she decided none of it was worth leaving her comfort zone. That decision kept our iron condors in conservative mode. It kept the adaptive layered hedge in reserve. It kept the entire system working exactly as designed. What the mainstream financial media missed this week was the patience. They focused on the sanctions. They focused on the potential for higher energy prices. They focused on the drama of a potential Fed leadership change. But what they missed was the tape quietly pricing all of it in advance. The pin at 7,398 was not an accident. It was the market saying we have already adjusted. The volatility at 17.2 was not complacency. It was confirmation that the adjustment had been sufficient. This bigger picture matters for every trader listening because it affects how you think about your own capital. In a world of tariffs, trade wars, sanctions, and Fed transitions, the path of least resistance is often to do nothing. But doing nothing means watching your purchasing power erode to inflation or volatility or bad policy. That is why defined risk income strategies exist. They turn uncertainty into math. They turn geopolitical chaos into theta collection. They do not require you to predict the next headline. They only require you to respect the current regime. And this week the regime was clear. Contango. Contained volatility. Selective risk appetite. Persistent but priced geopolitical tension. A Federal Reserve in transition, but not in crisis. That regime favors patience. It favors discipline. It favors the conservative iron condor over the speculative bet. And that is exactly what the tape was really saying. So let us bring this all together with the scorecard, not as a dry recitation of numbers, but as the logical conclusion of the story we have been living through together. This week we placed 4 trades. 3 expired worthless for full credit. 1 hit the short put for a defined loss. That win rate in a pinned low volatility environment is exactly what the setup promised. The volatility index gave us 3 clear placement days and 1 hold day. That pattern was her way of telling us to stay selective, to not force trades when the expected daily range was not offering enough edge. The conservative tier was the hero of the week. The risk scaling rules worked perfectly. With the VIX between 17.1 and 17.4, the aggressive strikes were appropriately blocked. The expected daily range stayed well behaved, never threatening the 0.94% gate. No martingale was needed. The adaptive layered VIX hedge stayed quiet. That is discipline in action. That is what separates those who survive geopolitical weeks from those who become casualties of them. The modified credit on the placement days averaged around $1.25 in the conservative structure. That is real income generated inside defined risk parameters. That is capital preservation and income generation working together. That is the entire point of this approach. We do not need the market to move in our direction. We need the market to stay inside the range. And this week, the market cooperated beautifully. The bigger lesson from this scorecard is one we have seen before, but it bears repeating. In a strong contango low volatility regime, strict adherence to the rules protects the theta collection while preventing oversizing. The layers are there when we need them. The hedge is there when we need it. But this week, we did not need them. And that is a win. Because using protection only when necessary is what keeps the long-term expectancy positive. This week proved once again that the system works. It works because it is built on respect for the volatility index, rather than arrogance toward her. She told us what she was willing to give us. We took only what she offered. No more, no less. That is how you build sustainable income in uncertain times. That is how you protect capital when the world looks like it is coming apart at the seams. And that discipline is what I want every listener to take away. Whether you are new to VixShield or you have been with us for years, the message this week was the same. Trust the process. Respect the regime. Let the volatility index set the tone. She has been doing this a lot longer than any of us. Tomorrow in our Sunday forecast, I will walk you through exactly what I am watching Monday morning. The economic calendar, the volatility term, structure setup, and precisely where our iron condor levels stand as we head into the new week. I will show you how the Powell to Warsh transition might affect next week's risk scaling and why the gold move we saw this week could be the canary in the coal mine for any shift in the dollar or yields. You will not want to miss it. The setup for next week looks every bit as interesting as this one. And be sure to listen for any breaking news from Miss Vicky. If you found this summary valuable, consider upgrading to Pro or higher for the full twice-daily VixShield market summaries, proprietary signals, and private RSS feed. Visit VixShield.com to learn more. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. And now you know what the tape was really saying this week.